We examined specific identification, which is very precise, matches the item sold with the cost. Next, we looked at Fifo, first in, first out. Then we looked at LIFO, last in, first out. And the next one that we're going to look at, which I like to refer to as meeting in the middle, is called the weighted average. And basically what we do with this one is every time we have a purchase of goods, we recalculate the average cost of the goods available for sale. Here's an example. Again, using that same one. We had 10 at 91 in our beginning balance, and then we purchased the 15 at 106. So once we purchase the 15 at 106, we come up with what is our total amount. The 10 at 91 plus the 15 at 106 equals $2,500. We divide that by the number of units, so we came up with a cost per unit of $100 per unit. So we're going to sell those goods at $100 a unit. If we have a purchase, the next purchase that we have, we'll have to recalculate that cost again. So there we sold, now we've got another purchase. We bring in the cost that we're carrying down, the 5 at 100, bring in the 20 at 115, again do the average, 2,800 divided by 25 units equals $112 per unit. So let's go ahead and you can see if you follow through how this all works. I think it's easiest just to start working through this. So let's go ahead and find our practice set number 5 is going to be QS56, QS512, and then we'll return to exercise 5.3 for the weighted average method. In QS56, we're again referring back to the information from QS54, but this time we're employing the weighted average method. So we have at first on the January 1st, our beginning inventory again is $320 at $3. On January 9th, we purchased 80 units at $3.20. Now to get my inventory balance, I'm going to add up how many units do I have. I have 80, the 80 units I just bought, plus the 320 units sitting in H8. So I've got 400 units. Then I'm going to do my total cost. So I'm going to say equals J8, sorry, it's covering up my info there, plus D9, the amount that I just purchased. So the total cost value of my inventory is 1,216. To get my item cost, the unit cost, I'm going to take the 1,216 and divide by the units. So my cost is $3.04 per unit. On January 25th, I make an additional purchase of 100 units, and I've purchased those at $3.34. Again, I'm going to add, now I've got 400 plus the 100, and my cost over here is the 1,216 plus, I forgot to extend that, but we'll just leave it there for now. I'll fix that, equals the 100 times 334. And so my total cost is $1,550. To get my unit cost, I'm going to say equals 1,550 divided by the 500 units. So I have a per unit cost of $3.10 per unit. On January 26th, I sell 350 units. My cost for those is the $310. So my total cost of goods sold is the $350 times the $310. My remaining inventory then is the 500 minus the 350, and value is 310. I don't need to recompute because the only time we recompute is when we have a purchase. So my ending inventory total value is 150 times $3.10. Let's go to QS 512. We'll be using the info from QS 510 to compute the cost with the weighted average method. On December 7th, we purchased 10 units. This is the one that doesn't have a beginning inventory at $6. And that becomes our inventory balance. We don't have to average anything. That's all we have, right? 10 at 6. And on December 14th, we have a purchase of 20 units at $12. And what we're going to do over here then is I'm going to add the 10 units and the 20 units to get my total units that I have available. Total cost I have invested in these units is $60 plus $240 or $300. My cost per unit is the $300 divided by the 30 units or $10 per unit. On December 15th, I sell 15 units. So I'm just going to sell them at that cost that I came up with before, the $10. So equals 15 times 10, $150. What do I have left? I have 15 units. Don't need to recalculate. It's the $10. So 15 times 10. The only time I recalculate is when I have a purchase. On the 21st, we purchased 15 units at 14, and that is going to be $210. So now I'm going to recalculate because I do have a purchase. 15 plus 15, I have 30 units on hand with an invested cost of $150 plus 210 or $360. My cost per unit is the $360 divided by 30 units equals $12. My total cost of goods sold is a sum of everything sold, which we only had one, but we'll go ahead and do it this way. Cost of goods sold, 15 units at $150. My ending inventory is right here. It's the 30 units at $120 or $12 each equals $360. Let's turn to page 221 and work through exercise 5-3 using the weighted average costing method. On January 1st, I'm not going to, so please have your books open. I'm not going to go up and look at the table. We have 140 units in our beginning inventory at $6. We sell. On January 10th, we have a sale of 100 units. And again, in all methods, this was the same because we only have one layer of inventory. So it's the $6 layer. On January 20th, we have a purchase. We purchased 60 units at $5. And remember, every time that we purchase inventory, we need to do the recalculation. So over here, after I sold, I have left 40 units at $6, and that equals $240. And I'm going to add the $240 plus the $300 of new purchases. I'm going to add the $60 and the $40. I have 100 units with an invested cost of $540. My average cost then is $540 divided by 100, $5.40. On January 25th, I have a sale of 80 units, and I sell those for the $5.40 that I came up with over there. For $432. So what do I have left? I have 20 units remaining at the $5.40, no recalc. And on the 30th of January, I have a purchase of 180 units at $4.50. That's $810. I'm going to come over here. I'm going to add my 20 units to the latest purchase of 180. So I've got 200 units with an invested cost of 108 plus 810. That $918 divided by 200 equals my cost per unit of $4.59. That is the amount that goes on my ending balance sheet, $918. This is the amount, 1,032, that goes on my income statement as cost of goods sold. Next, you're being asked to analyze this problem. So what we did, this is a full solution. I've got all of them together here. Remember, first we did the specific identification. That resulted in a cost of goods sold of $1,025, and it had an inventory balance of $925. The specific identification method, again, is the most precise. We're matching the goods with the goods, we're matching the goods sold with the costed goods, so very precise, very difficult and time consuming to do. Most of the time, the cost is greater than the benefit we receive from doing that. In number 2, then, we're asked to use the Fifo, first in, first out. Notice that this company has declining costs. That's very unusual. In a declining cost, what we're going to see is we're going to see a higher inventory and lower cost in the FIFO method than in the LIFO method. So here we have an inventory balance of 910, cost of goods sold of 1040 in FIFO. When we go down to LIFO, we've got the higher ending inventory of 930 and the lower cost of goods sold of 1020. In rising prices, which is the norm, this would be reversed. The LIFO would have the higher cost of goods sold and the lower ending inventory. So there's a trade-off for companies. They have to decide, do they want to report higher net income to their shareholders and thus use the FIFO method, or do they want to reduce their income tax costs and use the LIFO method, because that normally in rising prices does result in the lowest net income. The Internal Revenue Service issued a ruling that said whatever you use for your financial statement reporting, whatever method of inventory valuation you use, must be the same for income tax reporting. So we can't use FIFO for financial statement reporting and LIFO for income tax reporting. And then when we get down to the weighted average, as I said before, that's going to fall right in the middle. So we got a cost of goods sold of 1032, not right in the middle, but it's going to fall in the middle. So between 1020 and 1040, and the 918 ending inventory falls in between the 910 and the 920. To see that effect of rising prices, remember this QS 510, we computed the FIFO LIFO weighted average and specific identification for that problem as well. Well, under the FIFO method in rising prices, we had a cost of 120 and an inventory balance of 390. Then when we went to the LIFO method, our inventory went down to $330 because remember that's the lower numbers, and our costs went up to $180 because we're reporting sales at the higher prices. Then when we looked at the weighted average for both the inventory balance and the cost of goods sold, we fell somewhere between the two. And that concludes lesson 5.